Okay. Everybody can hear me?
Very good.
Wonderful. Okay, fantastic. Okay, good morning, everybody. I'd like to welcome you all to the Daily Energy Markets podcast. I'm delighted today to be joined by Bill Spindle, Senior Global Correspondent at Cipher News, Andrew Lavin, Senior Partner at Econs, and Mukesh Sadev, SVP, Head of Downstream and Oil Trading at Rystad Energy. Thanks, gentlemen, for joining us this morning. We just had the answer to the survey question that we did yesterday, which is about Brent and its direction before the end of Q1 in March. But I'd like to, Andy, maybe go to you first and ask you whether, let's forget March as we're nearly the end of there, but do you see us hitting this $90 in the next quarter? And if so, what would you say would be the main reasons for that or against it?
Oh, goodness me. How long have we got? So in that shorter time period, I think I would very much agree with what has been said previously on the podcast, is that the general trend is up. Yes, there's going to be some volatility up and down, but in reality, it's kind of noise. It's trending upwards, and it's trending upwards because of the geopolitics, because the demand is coming back slowly, although there are some challenges. The supply is a little bit tighter than it should be or could be. OPEC is cutting, they're not pushing more volume out. So the general trend is up, but I think we're going to see it testing kind of resistance in a lot of places, and it'll bounce back. Before we started, we were talking about it's kind of come off the recent highs, but I don't think it's going to start trending down. I think it's going to be trending up through the first quarter into the second quarter, unless something fundamental changes, like OPEC go, oh, goodness me, we've got an enormous crunch and we need to pump more, which I don't think they're going to do.
Okay, thanks, Andy. Bill, let me go to you on that. Let's just talk a bit about China, just to get your thoughts on that a little bit in terms of demand. I mean, again, part of the sort of turnaround, I suppose, to the uptrend in the last week that we've seen, the trend in the price has been up for a couple of months, but I mean this sort of renewed optimism of the price, getting higher a bit faster. I mean, we've had a few comments also in China. Oh, everybody's dissed that it's going to be disappointing this year, but it's perhaps not. From your sense of what you're hearing, would you expect us to see, a stronger than expected growth and oil demand there than perhaps we might have been expecting?
I wouldn't expect stronger, but I would expect the kind of trend we've seen continue on, where China's economy continues to struggle. This property thing is not going away for quite some time, and probably will get worse. That's going to be a certain undertow on growth for sure. It's not looking like there's going to be any gigantic bailout package like we've seen at some points in the past. But energy demand has remained pretty strong despite this, struggling with the property sector. And that's largely because they've kept up a lot of this manufacturing, and a lot of this manufacturing has been in the clean energy sector, right? EVs, solar panels, and you name it. China is just going like gangbusters manufacturing this stuff, partly because they need it and plan to use it to keep up with their own longer term galloping energy demand, really, but also as a way to keep the economy afloat. So I suspect you'll kind of see the same thing. I doubt you'll see a big uptick, because China is not going to, I don't think, go into a sort of cyclical upturn. It's really in a long-term struggle, similar to what Japan went through with its property market. But it does have this huge manufacturing base that it's relying on, and that's going to keep energy demand, I think, not nearly as struggling, not nearly to the point as the overall economy does. Even if
Bill, I mean, while I have you, and just addressing the transition in China, because we had a comment from one of our speakers yesterday who said that, in his opinion, that China would actually, in its transition plans, switch, from one day from coal straight to renewables in terms of that flip, a decisive flip upward, and skip the gas. Essentially, it's obviously a gas importer at the moment, but it's not going to use gas as a transition fuel as other economies might. Would you agree with that? I just wanted to get your thoughts on that.
Well, I mean, China is an absolutely massive economy and broad-based energy user. It's going to use all types of energy. I mean, it's not going to skip anything. The last thing the Chinese are thinking about is skipping any sort of an energy source they can figure out how to use and get into the system. And that includes gas for sure. But it may not, you may not, we'll have to see. It is quite interesting to see how this absolutely explosive growth of renewables that they're putting on the system ultimately pans out. Does it just keep them sort of treading water, so they still need a lot of gas, so they still need even a quite expansive coal use going forward, or does the gas sort of that stage of it kind of get trimmed and it's just less than many in the gas industry would hope or would like to see? But they'll be using plenty of gas, along with tons of renewables, as well as a lot of coal.
Everything that's in the basket. Mukesh, good morning. Let's get your thoughts on prices as well, in terms of this sort of trending upwards and the factors that have been, supposedly causing that. OPEC cuts are very big. I mean, they're really the price trend and the stability of the oil price is being completely attributed to the supply side of OPEC plus cuts as opposed to recovering demand. Would you agree with that? And do you think, like a lot of people we've spoken to the last week, that OPEC plus are going to have to keep these cuts, the voluntary cut part, in place really for the entire year because demand is pretty uncertain?
No, I think that's an interesting topic. And I've been saying this for quite some while, that OPEC plus is probably targeting to keep the market in the backwardated structure, rather than, so they don't want anywhere the market comes to a surplus and flirts with contango, because once it goes into contango, then it doesn't, their levers to control the market becomes difficult. So more than the price level, I think they are committed to keep the market in a backwardated state. And now whether the price achieves, once in a while, few days, $90 a barrel or somewhat higher, I think that to me is less important. But what I want to point out is that there are two reasons why we will not have breakout price spikes, right? Those two reasons are, number one, we have enough spare capacity in the world. So the fatigue of conflicts is there. We have 5-7 million barrels of spare capacity. So OPEC can any day bring those barrels if prices really go high, number one. Number two interesting thing, which I was discussing before, is that I'm calling these days, there is a circular reference in Middle East. Now, what I mean by that is that pre-pandemic, Middle East crude production has declined roughly by 28.6 to 20, some 2 million barrels per day or 1.7 million barrels per day. Their exports have declined by roughly the same amount. But the refining system in the Middle East has gained since 2020s about 1.7 to 2 million barrels per day of refining capacity. And they're running those refineries. And these refineries are exporting products of 1.5 to 1.7 million barrels per day. So how on earth is possible that you run 2 million barrels per day more crude, you cut exports, and you cut production? So there is something that does not add up. And because of the product exports, which Middle East is doing to other countries, this reduces the call on crude by other countries because they are getting the product, so they don't have to run their refinery system. So in some ways, by exporting a lot of the products to the rest of the world, Middle East is in somehow working against itself to increase the crude price. Imagine a world where they cut the crude and they don't produce any extra products. Then the rest of the world will scramble for refinery products, and then they will start to pay very high prices for crude oil and attract the crude oil. So it's kind of spare capacity by Middle East, and also what I call the circular reference, that exporting products, and I think they're diversifying their profits rather than putting all eggs in one basket.
Okay, thanks, Mukesh. Andy, I've got a couple of headlines today on the bulletin. One is that U.S. crude oil and gasoline inventories continue to drop. That's supposedly a positive sign economy-wise for the U.S. And also another one that says U.S. aims to restock its SPR by the year end. The whole SPR thing last year whittled away a bit, you know, having been a headline news the year before. Where would you, how do you think the US administration today, in terms of an election year as well, is looking at SPR, reserves, controlling the price through that, gasoline prices, etc.? And how sensitive do you think we are, or is it comfortable where things are at the moment?
So I think I'm not sure that the US is really going to do anything that's going to make a difference to anybody else other than themselves. Their focus is going to be domestic politics, and they'll do whatever they can to bring prices in line with the customer expectations and not see prices going up. So gasoline price is going to be really important. It always is in the US. But reality is Bill's probably better positioned to talk about the US than I am in terms of kind of what the politics are going to do. But it's all inwardly focused as far as the kind of coming into an election year, and that's going to be their main focus in terms of price, and refilling the SPR and crude draws is something that traders and businesses look at, but the politicians are kind of like, yeah, but what about the voters?
Yeah, and what about, Bill, you know, the interest rates as well in the US? I mean, again, talking about the US economy, sentiment, where that's going. The Fed will be speaking again this week. A lot of central bank sort of statements coming out this week. And this, again, this sort of turnaround, in a way, at least the market now beginning to believe that, oh, well, you know, and the inflation number is still telling us that we're not going to see that many cuts in interest rates, etc., which, again, it's all about expectations, right? How is that new expectation feeding into consumer confidence, do you think, in the US? Because it is the economy that held everything up last year, right?
Thank you for not asking me to predict the politics. I'd much rather be trying to predict yeah, I mean, I think, you know, that it really is about, you know, we're inflation around 3%. We had an economy really plugging along better than surely anyone predicted a year ago. So it's really about how tough is that last percent going to be, and how determined is the Fed going to be to go after that last 1% in an election year. Almost certainly they'll leave things steady from here. Maybe we see fewer cuts, certainly before the election, say. But you know, again, depending on the numbers come in, I would be surprised if they didn't start cutting in June, and maybe continue depending on where things go. But a lot of it depends on whether we see a little uptick in inflation, which, you know, could then indicate that last percent is going to be tough, and it could turn out to be tough. That's really where it depends on those numbers. Okay.
All right. Thanks. Mukesh, let's talk a bit about Russian oil, whether it's crude products, etc. You know, and then also in the context of its position from a crude export point of view within OPEC Plus, we were talking about that earlier. You know, OPEC is going to be possibly resetting some quotas in June, possibly not. Russia has kind of been given, you know, a bit of a free hand by Saudi and the OPEC Plus leadership to kind of just do what it needs to do, continue to getting the oil everywhere it needs to get it to. Any concerns this year that we'll see any change in Russia's ability to export what it wants to produce what it wants to domestically? Are you getting any of those indications on the ground?
Now, a good question. I was in India for the last 2 weeks, and I met a lot of, you know, big players over there. And I think there is a sentiment that, you know, Russian crude still remains very profitable business. Of course, some of the discounts eroded. And there was also a talk around that by sanctioning and tightening the Russian sanctions is actually helping India, because then Russia would have to clear barrels with a bigger discount. So in some ways, is this sanctioning and tightening actually helping India and those countries buy more Russian crude oil? I think the key point to note now that Russia's crude production system and refining system is now finally under significant strain. Like, you know, they continued. What you see now with the Ukrainian drone attacks, almost 2.8 million barrels of, you know, those refineries, 5-6 refineries have suffered. And I guess that Russia will not be able to run maybe 300,000 barrels per day of crude. So 500,000 barrels per day of crude processing in Russia is under trouble. Now, what that means is, can Russia export what they don't consume? I think Russia doesn't have probably all the storage systems to manage this transition. So I guess that Russia made a pledge or talk about production cuts. Probably this is the reason they will actually do the cuts now, because they won't be able to export so easily, and they won't be able to consume themselves the crude so easily. And then for the domestic pressures and elections, whatever you call Putin, right? They have also banned exports of products because they fear. So Russia's ability to export crude oil, Russia's ability to export refined products is going to be challenged, particularly gasoline. And that's why we are seeing that overall there is an octane shortage in the world. And that's why we have seen the US, gasoline futures are rising, even when, we are a little bit far away from the peak driving season. So limited ability for Russia to keep the market volatile and prices elevated.
Okay, thanks, Mukesh. Andy, just to go back to you on again, just talk about Europe. In terms of economic health generally and demand there. We sense there's a bit of a more optimistic tone about the European economy. I mean, it's still struggling on many fronts, including in Germany, but there have been some headlines and stock markets are doing very well there as well, relatively speaking. No gas price issue, this winter, for 2 winters in a row almost. So what's the sentiment there, and what can we expect to see in terms of demand for gas, etc., and the outlook there?
Cautiously optimistic, I would say. I think, as you put it, they've certainly struggled. I mean, you look at Europe versus the US, and it is a tale of two continents. Europe has really struggled to come back ever since COVID, really, and that's been for a bunch of reasons. It's partly politics, but it's also kind of the Russia-Ukraine crisis has had a much bigger impact in terms of European supply because they were so tied to Russian output. So I think, there's been a lot of effort and a lot of money spent changing how things flow. And now things are starting to become a little bit more consistent. And that's what's giving drive. I believe it's what giving rise to the cautious optimism. But we are certainly not out of the woods yet. Interest rates still have a long way to go. Inflation really isn't under control. And I mean, I've said this a number of times previously. I remember when interest rates in the UK were way higher than they are now. But people don't seem to remember the history and see what we've got today is really high interest rates, not really high interest rates. It's just actually, if you've got interest rates where they are today, it just means actually you've got to work harder as a business than you did 5 years ago. But actually, if you go back 20 years ago, the interest rates were 3 times what they are today. So you really had to work hard. So anyway, to come back to your question, cautious optimism. I don't think we're going to see the challenges we have seen over the last year or so, but it is slow going and it's like walking through mud.
Okay, all right. Well, good luck to Europe there. We have the survey question for today, which is some comments that came out of Aramco at CERAWeek from Amin Nasser, which is talking about oil demand and phase out of fossil fuels as a fantasy, and energy transition is visibly failing. Agree or disagree? Which is really interesting comments, given Saudi's recent comments about its capacity increase plans and how it's going to sort of slow those down for the time being. So interesting there. Bill, I'm going to go to you with that and ask you, do you agree or disagree that he's right, and why, and how, and is that interesting? I mean, what do you think is spurring Saudi to say that? We know that Saudi Arabia is pumping and its 10-year plan is to continue to do that. How do you interpret those comments?
Yeah, I think it kind of depends on what he means. We were talking about this in the so-called green room beforehand. It's, if what he means is the world is falling way behind the goals it has set for decarbonization and energy transition, then that's demonstrably true. It's failing in that sense. So in that sense, he's just stating the obvious. I think in fact, he'd find himself in agreement with a whole lot of climate activists about that. If what he means is it's not happening and not going to happen, that I would disagree with, and I think anybody who's going to aggressively pursue that line is going to find they're going to have to adjust going forward. And when you talk about the 2035 range, will we be at a peak then? My feeling is whether we peak or don't peak is far less important than whether a foundation is being put into place where demand begins to fall quite rapidly from whenever that peak is. And if that peak's 2035 or even after 2030, it's more important that it declines rapidly than that it
then when it happens. Yeah.
And I think would be the thing, and that's where I think he's doing a little wish casting.
Okay. All right. Thanks, Bill. Mukesh, let's talk a bit about jet fuel, because that is one of the elements that is expected still probably to lift, the market up this year, right? Amidst other products. Manufacturing's down in Europe, US is doing okay, China's having its challenges, but travel still recovering from COVID. People have liquidity, affordability to do that. Give us your outlook for that. Are we going to get a big push into the summer for that, both from a Chinese demand point of view, which is a big one, but also Europe? I mean, we have travel agents saying, oh, we're going to have record travel again in Europe this year. So is that still pulling the balance up, if you like?
No, I would say that, yeah, let's brace for some real sparks in the jet because for two fundamental reasons is that from now is the low jet demand period, and seasonally 500 to 600 KBD, there is a growth of jet demand seasonally that happens. And in order to fulfill, particularly in Europe, Europe has been managing by importing those barrels from outside. Now, with the Red Sea crisis brewing and not ending, and I don't think anybody, because there are a lot of winners from the Red Sea crisis, so it's not going to end soon. That means that Europe will struggle. Now, if Europe cannot import, then Europe refining has to make its own jet. Now, to make jet, typically you can only make 8 to 9% jet from your refining system. The call on European refining system to make jet is about 10%, 12%. Now, even 0.5% making jet is a big deal because to make 1 barrel of jet, you need to push 10 barrels of crude. Crude is not there. OPEC is cutting. Russia is cutting. Russia is not exporting product. Russian refining is in trouble. So if I put all those kind of factors together, European Atlantic travel, price spikes, jet demand, I think certainly is something to watch out. I don't see an easy answer for that solution.
Okay, thanks, Mukesh. That's interesting. Andy, let's talk a bit about the Red Sea and shipping and sort of movements there. We've obviously had disruption to shipping in that area. The oil is still making its way to its destination one way or another. Costs of shipping have increased, etc., for those who are looking to send that product. But again, despite the fact that we see no end to the tensions and problems in that area, the risk premium really isn't budging up, isn't it? For that reason. Andy, and do you think we've settled, like we had with the Ukraine-Russia situation, into this sort of, okay, well, this is not going to be resolved anytime soon, but that's it, we're okay, and the premium is kind of going to sit where it is?
So I think it depends on what your definition of risk premium is. So as soon as something becomes essentially the status quo, the market rebalances, and it just becomes that's what the price is, right? So you've got people who can choose to go around and outside the Red Sea are spending more money. So that's going to make their costs higher. There are people like Saudi who have no choice. They've got refineries in the Red Sea. They're not going to shut the refineries down. So they're moving crude, they're moving product through the Red Sea because they have to. They have no other choice. So in reality, most of the products is still moving to where it needs to. Some of it's going longer distances and taking longer, but that's what the oil market's really good at, just rebalancing the system. So to me, a risk premium is when, something might happen, something could change, whereas actually what we've got now is pretty much a status quo, and whether you're looking at the Russia-Ukraine crisis or you're looking at the Red Sea, it is pretty much the status quo now.
Okay, thanks, Andy. Bill, just to go to you on a bit of a sort of general, again, economics of a question, but how about other, we're talking about the US economy, we've talked about Europe, China, other sort of South Asian economies, if you like, emerging economies, and their sensitivity to the oil price as it is. It's been relatively okay for a few months, but countries like Pakistan and other countries in South Asia which are more price sensitive. How are they doing? What's the outlook in terms of their demand for oil and gas at these particular prices? Do we expect, better news this year because of less volatility, perhaps, that we're going to see in prices? And of course, we've got the whole dollar strength, haven't we? And if we can address that, and whether you agree that that's kind of on its slow way down, although we saw a bit of a hiatus this week, but the dollar has kind of reached its peak.
Yeah, I mean, I think I'd point to two things to watch. One is where Japan goes after they've sort of taken first time in 17 years raising rates. That's put Japan into a bit of a new economic situation. When they tried this the last time, 17 years from now, they were coming off a long period of every time they'd raise rates, the economy would stumble. They would go back down to zero rates. So, I think Japan's interesting to watch to see if it's able to sort of build on the strength that it's got there. And the second thing I think is debt overall. I mean, I think we're still in a really serious situation in the developing world with debts in places like Pakistan, Zambia, Egypt. Will we can the world work its way through this without major implosions of some of these countries that could trigger larger kind of reverberations?
Okay, thanks, Bill. Mukesh, just back to you on, again, the refining. You mentioned Middle East refiners and the impact and on the products and crude market there in terms of exports. Let's just talk to you a bit about China, because the petchem sector has been the main impetus apparently behind crude imports and therefore obviously for refining purposes. What's the sense for you for Chinese sort of refining in the year ahead with that increased capacity in petchems? And also the quotas that were set in terms of their exports into the region, more stability there for the stakeholders that play into that or not? You're on mute.
What I would say, what I would say is that nowadays we are living in the world where markets are very fragmented and fractured supply chains. So I think there are no global averages, and in making reference to previous global peak demand, I think there are sectoral differences, there are regional differences. Even within China, I guess some of the sectors are doing good. I think some of the data that came out on Monday was higher than expectations, for sure. So I would say that petchem demand is improving gradually, for sure. And there are a lot of commentators that maybe we'll come back to the pre-pandemic levels of demand growth by 25 and 26. But we are not in a negative territory. We are in a down cycle, but we are not in a negative growth territory. The growth is still there. So I would say that China is preparing itself. China is long refined products. China is short petchem, and China has set up now big petrochemical plants. China is benefiting a lot from the cheap gas. China is benefiting a lot from the cheaper naphtha that has flown from, which used to go to Europe by Russian naphtha. So Chinese petrochemical system would come back, but not in 2024, I guess. It could be a more 25 or a 26 story. But overall, I see we are not in a negative growth. We just don't have the previous years kind of a growth. So it's a bit of a down cycle, but it'll come back.
Okay, thanks, Mukesh. Andy, I'll just go back to you. Last question, just your views on gas prices, generally speaking, the trend. Well, let's just look at the survey question there. So agree, 73% agree with Mr. Nasser there. So, okay, well, we can, and Bill gave us a bit of an interpretation on that question, but there we go. That's our answer for today. Andy, just on terms of the gas sort of price trajectory, we've seen, US gas prices at almost all-time lows. Obviously, that's translating in different ways across different regions on domestic gas prices. But given that we've got this medium long-term supply coming online on stream in the next year or two, what is the trajectory there, do you think, for that? I mean, are we going to stay at these very comfortable levels for consumers?
I hope so, because the low prices are actually the key to unlocking the energy transition in reality. The lower the gas price, the easier it is to use gas as a transition fuel. And I think there has been a lot of focus on bringing on gas supplies. You can even see gas is now a focus in the Middle East in terms of Saudi and other locations. So more gas is good for the energy transition. What's going to push the gas price up? Demand more than anything, right? Supply is there, supply is coming on stream, more people are exploring. So even in the medium to long term, the supply hopefully is okay. It really is. If suddenly the demand picks up for gas in a way that is unexpected, that's what's going to push the prices up. So at this point in time, I think they're hopefully going to stay low where they are.
Yeah, we'd have to see that demand kick in pretty soon, because from 25 onwards, we do have quite a bit of supply coming on.
Absolutely.
And as you said, those long-term plans, Qatar recently announcing Saudi more and more production. Thanks so much, Andy Lavan, and thanks to Bill Spindle and Mukesh Sadaf for joining us today on the podcast. And there we have our halftime talk, which is being published in the next hour with Narendra Taneja, India's leading energy expert, on the Indian economy. We didn't talk too much about that, but many people are very positive about at least the Indian economy going forward. Thanks so much, everyone, for joining us, and have a good day. Thank you.
You too.
Thank
Bye-bye.
you all. Bye-bye.